Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options.
With that in mind, once again, maximum risk, $1.42, maximum profit, $1.58. So we essentially have a 2-to-1 risk-reward proposition here, which I think is appropriate for a debit spread strategy. If I wasn't able to make 2-to-1 based on the net debit of my position and the strike price sold, then I would typically look to stand aside. Now we talk about the and again here's the maximum risk versus maximum profit potential as illustrated here by our little profit and loss chart. Now we talk about the idea of also taking advantage of multiple of an expectation in an increase in implied volatility. And the strangle or the straddle, we're going to focus on the strangle tonight, but these strategies, or this strategy particularly is used when you're not sure what direction the market is going to go, but you're comfortable with the level of implied volatility, and you're just looking for a big move either in one direction or another. Now, this strategy involves, of course, an understanding of implied volatility. So in this case, we're looking at a snapshot, courtesy of Options Express, of the implied volatility surrounding the EUI, which is of course the U.S. dollar versus the euro. Now, in this case, you can see that historic versus implied, historic being red and implied being blue, is relatively close. We're within about 2%. Now, an ideal scenario for options buying would be a scenario like this. Now, you can't see it, sorry, because the background is yellow. But an ideal scenario would be when implied and historic are very close to one another. But we would look to be an option buyer in circumstances where implied and historic volatility is relatively close, and we expect an increase in implied volatility. So the strangle, for example, gives us a way to position ourselves both long and short. So in other words, buy a call and buy a put at the same time on the same pair value, same expiration, different strikes. Now, the reason why it's referred to as a strangle is that we're using different strikes. A straddle simply means we're using the same strikes. Now, in this scenario, we're looking at the EUI trading at approximately 73.60. Now, we may expect that the pair is going to be volatile. We just don't know which way. Really, what this observation equates to is us looking at the U.S. dollar and the euro right now and saying, who knows which way it's going to go? This thing is so volatile. It's been going up. Euro's been going up for a while. Now it's going down. Not sure what's going to happen, but something big's going to take place. So in this case, March 75 calls we're asking $2.15. March 72 puts are asking $1.72. In this case, we would buy the 75 strike call at $2.15, buy the 72 strike put at $1.42, and the net cost is going to be $3.57. Maximum risk is the net cost, which is $3.57. Now, we have to consider the break-even points on this particular trade, because now we're the buyer of two separate option contracts, which means the cost basis is going to be that much greater, and we have to add that to the upside break-even point and the downside break-even point. So in the case of the pair value moving to the upside, our break-even point is going to be the strike, which is 75, plus the $3.57 premium, which brings us to 78.57. On the downside, it's going to be the strike, the put strike, minus the actual net debit, which brings us down to 68.43. So realistically, we need to see a fairly significant move either one way or another in order to profit. Now, what we're looking at here is a weekly chart. And the reason why I used a weekly chart, guys, is because I wanted to be able to incorporate why we might consider a strangle on the EUI. And it's really looking at where the U.S. dollar was historically over the last year. compared to where it is now, and we're almost middle of the road in terms of where it's trading at presently. So in this case, we might say, look, okay, we might see the EUI go all the way back up to 82, or we might see the EUI go all the way back down to 66. In either way, we don't know where it's going to go from here. We're at some fairly significant crossroads. Let's buy a call and a put, and let's see what direction this thing starts to move. Now, recognize the worst thing that can happen between now and March is that the pair stays range-bound between our strike prices. In that scenario, both option contracts are going to lose value. Now, the benefit of being able to implement a strangle is that at any given time you can offset one side of the trade. So in other words, if we start to see the pair move up in our favor, well, we don't have to sit back and hold the 72 puts until they expire. We can offset that and now continue to manage our profitable position as the pair value moves to the upside. Similarly, we can do the same on the put side. If the pair reverses and starts to drop and the U.S. dollar starts to lose value again against the euro, well, we offset the calls, we salvage what we can from those premiums, and we ultimately look at managing the put options from a profitable position moving forward towards expiration. Now, that being said, because these positions are not part of any sort of a debit spread strategy, ultimately, we can offset either side of that trade or the entire thing at any given time. So if we look at the net position at any given time as being greater than what we paid, we can offset it for a profit. So it's certainly something to consider, recognizing the fact that we can manage each side of this trade separately based on our objectives. Now, with that in mind, once again, the strategy has us being a buyer of both the call and the puts. And you can see here essentially from the profit and loss graph that the maximum risk is anywhere between our strike prices, considering our break-even points. We really need to see a significant move in either direction in order for us to profit if we consider holding both sides until expiration. Now, if we are looking at a particular pair that appears to be, number one, range-bound, and also have an implied volatility that is expensive, we can actually sell that strangle. So essentially what we're looking at doing is, instead of being a net buyer and looking at taking advantage of a move in either direction, we're going to be a net seller, and we're going to take advantage of the pair remaining range-bound for a certain period of time. So in this case, our consideration here is, number one, that option premiums are pricey, and we're going to collect a nice juicy premium from being a writer, and that the pair value is going to stay range-bound. Now, typically, we're going to use short-term options because ultimately what that allows us to do is to capitalize on an accelerated rate of time depreciation, because remember, as an option buyer, time works against us. As an option seller, time works in our favor. Now, that being said, what we're going to do is we're going to receive a credit for selling both the call and the put option. Full profit is going to be realized when both the call and the put option expire. So one of the benefits is that you're only getting nicked on your commissions on one side of the trade. Ultimately, if all goes well, the options expire worthless, and you don't have to offset either side of the trade. So you save a little bit in that respect. So the challenge for this, though, is that you're going to be required to put up margin, because remember I said there's a very distinct difference between being a net debit trader and putting up capital and being long a call option, and actually being short the call options. We're going to be required as the option writer to put up a debit. So in this case, what I'm looking at here is the CDD once again, and again, the implied volatility at this point being not too bad in terms of its relation between its historic, but also certainly not perfect. But a typical environment where we would consider being a net seller would be in a scenario where implied volatility is significantly higher than historic volatility. That's when option premiums are going to be pricey, and the option writer can collect the greatest amount of premium.
Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.